Good evening, all the clients. Welcome all of you on behalf of NJ. My name is Darshan Dhanesha. I am taking care of North Gujarat. So today's session is very important and very energetic session for all of you because we have a speaker Amit Groverji. Amit Groverji has a experience of more than 16 years in the industry. Amit Groverji is a mechanical engineer, MBA, CFL level 3 candidate, and he is heading of HDFC AMC as a learning and training and learning department. Prior to HDFC, he has also worked with a IDFC mutual fund and DSP mutual fund, heading learning and development. So Amit ji has taken more than 1,200 plus sessions for the banks, national distributors, MFDs, RIAs, about and investor programs and many more. So topic covered by Amit ji was equity, fixed income, behavioral finance, international investing, history of markets, macroeconomics, and personal finance. So in this time, we need to understand basics and advance from Amit ji that what is a wealth building. So not taking much of time, I welcome Amit ji for this wonderful session. Please take from here.
Okay. Uh, Hello, all participants. Welcome for a very interesting session on big money mistakes. Why even smart people make big money mistakes. Okay. This session is extremely important. I will just load my slide and my presentation. And today we'll talk about the big money mistakes. Obviously, this topic is not about what's happening with markets in the last 5, 6, 7 months. Why are FIs removing money? Why is earnings getting downgraded? What is happening to Donald Trump's tariffs? Why is India's GDP slightly slowing down? Why the earnings have not been great? uh, Till what time markets will correct. So we're not going to talk about these topics. We'll talk about something which is much larger. How do you make sure that you don't make big money mistakes in the entire journey of wealth creation? How you can follow timeless principles of wealth management and make sure that you and your entire family is able to achieve all your financial goals with very less amount of stress. So let's start with a very basic thought. Okay, today's world, all of us, you, me, we live in the very amazing modern society. But to understand human beings, to understand the hardware and the software, which is human brain, we'll have to go back to evolution. So basically, we all know money is a rational subject. Math, science, and balance sheets, everything is important. But actually, more than that, money is an emotional subject also. Psychology and emotions play a very critical role in terms of how we deal with money and investments. That's why understanding evolution and human brain becomes extremely important. Just try to imagine if a simple 200 pages book is written about human beings, about the entire evolution. The first 199 pages of the book will be about human beings in Stone Age. 199 pages out of entire 200 pages book. Just one page will be written about all the stuff in terms of agriculture. Agriculture is a very recent phenomena as per evolution. And whatever history, little bit we know, the Maurya dynasty, the Gupta dynasty, okay, what happened in the last thousands of years can be written in just one small paragraph. And what we experienced in the last 500 years can be summed up in just one line. So, what I want to tell is basically how we think, how all of us think and behave. The programming is already done by thousands and thousands and thousands of years of evolution. So, it's so important to understand what happens in a human brain. Like, you don't have to teach a bird how to fly, it is part of its DNA. Similarly, a fish, you don't need to teach a fish how to swim. Even that is also part of the DNA. Similarly, how we all of us think and behave is also part of our DNA. So let's try to figure out what are the big money mistakes, what are the behavior mistakes we keep on repeating time and again. What do we learn from behavior finance, and how do we become better investors so that we can create wealth in the logical fashion? So let's start with a very basic thought. See, broadly, all of us, all human beings, all of you, me, everybody, we all are same. But at the same time, we also are very unique. Why do I say we are all unique? Because we have got different DNAs. When we have different DNAs, that means your behavior, my behavior, we basically are very different. And we have experienced it at home also. When we have children, basically same upbringing, but children have different behavior. Even among siblings, we can see such big differences between me and my brother, me and my sister. There's a big difference in terms of behavior traits. Besides DNA, how our upbringing takes place, because a human brain is also very malleable, or it's very plastic. So what we experience, especially in our initial years, okay, basically decides how we look at money, investments, risk, and various aspects of life. In fact, a very interesting point, human beings have a very long childhood. But if you look at the jungle in general, majority of the animals don't have the luxury of such long childhood. The moment a giraffe is born, it has to stand up on its feet, and it has to start walking, and maybe after some time running also, because it has to survive. But a human child, a human being, okay, for many years it has a childhood, and a human brain gets developed, and it absorbs so much things from parents, from society, from school, from friends, from relatives, and the entire surrounding. But at the same time, we are also unique because we have also experienced the world in a very different way. Our upbringing, the traumas, the experiences, the excitement, the joys, even the philosophies we built about money and life is quite unique. And that's why we always say personal finance is more personal and less of finance. We'll try to understand all these nuances, the big money mistakes, and learn from all these mistakes to be a better investor. Let me try to explain you with a very interesting story, because a lot of people think, okay, I'm very smart, I'm very intelligent, these are my degrees, I'm very well qualified. Then why are we even discussing that? In spite of so much knowledge, why can't I create amazing wealth? And let me try to explain this concept, why more than IQ, there is something called as EQ, which is called as emotional quotient, that is extremely important for wealth creation. The story goes 500 years back. This is a story about Newton. Okay, we all know one of the finest scientists in the world. Gravity and all the formulas, if you remember, the Newton's first law, Newton's second law, Newton's third law, everything basically got invented, discovered. Majority of the stuff got discovered by Newton. The story is 500 years back. Newton happened to invest into a stock which was basically called South Sea. South Sea was an interesting company. It had exclusive rights to trade with South America. So there was an interesting story, a company which has exclusive rights to trade with South America. I'm sure many of us, including you, me, would have loved to buy this stock if we existed in that era. So Newton bought this stock. After some time, the stock price went up. Newton was very happy and he sold his stock, like how typically many of us do. But then over a period of time, okay, Newton was just happened to go in one of the parties where actually he met many of his friends. And during normal conversations, especially with his friends, he realized that majority of his friends had invested in this stock, and they had put big amount of money, and they were getting extremely rich because the stock was only going up. Now, this is where things become interesting and at the same time very messy. When you see your friends, your relatives, somebody who's very close to you making tons of money, especially if you think you are smart and maybe those people are not that smart, but still they're making a lot of money, a human rational brain stops thinking. It behaves very illogically, very irrationally, and I'm sure the similar thing would have happened for Newton also. So what did Newton do after that? He put his entire life's savings, whatever he had earned, or whatever he has basically made through inventions, through discoveries, he put his entire life saving into that just one stock. The stock moved up for some time. Newton made money, but then for some reason, that stock almost had a free fall. And when the stock was falling, almost coming to zero, Newton sold his stocks and he completely exited. So obviously, Newton lost a lot of money in this stock and in this entire investment process. Once Newton was asked about what happened and why he made this financial blunder, to which Newton explained it something which should be a lesson for all of us. He said that I can understand the movement of all the planets, stars, galaxies. I can do the calculation. But the only thing which I can't understand is the human brain, the human madness, and how we get carried away with emotions and drama and all that stuff which happens when we look at things going up and down. And this is a very important lesson for all of us. If you look at the world of finance across the world in India, you would realize nothing has changed. The same things, the same mistakes which were happening 500 years back, or 100 years back, or 10 years back, the same mistakes are happening right now. And then the same mistakes will keep happening for the next 10, 20, 50, 100, and I'm sure even for the next 500 years. So let's try to understand what are the big money mistakes and how do we become better investors over a longer period of time. Now, before talking about big money mistakes, I would like to highlight the beauty, the wealth creation, what mutual funds can deliver over a period of time. And over here, I'm taking an example of HDFC FlexiCap. HDFC FlexiCap is one of our flagship funds, a fund which recently completed 30 years on 1st Jan 2025. This fund started back in 1995, 1st Jan 1995. Obviously, this fund started with the NAV of 10. Look at the journey, and this will be a very good case study for all of us to understand how wealth creation happens in mutual funds. How do you create multi-baggers in mutual funds with time, patience, and discipline? And how even a small SIP of 1,000 rupees or a 5,000 rupees or even 10,000 rupees can create humongous amount of wealth over a longer period of time. So this fund started back in 1995 with an NAV of 10. And when we look at the NAV, which is on 1st Jan 2025, in these 30 years, the NAV almost moved approximately to the level of 1900. That means the money multiplied almost 190 times in the period of 30 years. Now, we always look for multi-baggers and we forget. We look for multi-bagger stocks and all that stuff. We forget that mutual funds are the biggest multi-baggers. In 30 years, the money moved up approximately 190 times. At the same time, we all know the power of SIP, the power of investing on a monthly basis. If an investor would have done a 10,000 rupees SIP, so 10,000 means in a year you invest 1.2 lakhs. In 30 years, the value is 36 lakhs rupees of investment. The value becomes approximately 20 crores 65 lakhs. Yes, you heard it right. 20 crores 65 lakhs. But now you might argue, who had 10,000 rupees approximately 30 years back? Because 10,000 rupees was a big amount. Fine, I get your point. Even 1,000 rupees SIP would have still created a wealth of 2 crores, okay, and 65,000 over here. This clearly shows how even a small amount of SIP, but done in a disciplined fashion, with time, with patience, creates amazing wealth over a period of time. But the problem is that when we talk about such examples, people think, oh, it might have been an easy journey. Wealth creation is easy. But let me try to explain you the big money mistakes which happens in the entire journey. A word of caution over here. I put a disclaimer. Past performance is not a guarantee of future returns. Many investors always have a discussion that, okay, fine, this happened in the past. Is it guaranteed for the similar thing to happen in the future? Obviously, we're talking about future. Nothing is guaranteed. The idea is past is a very good indicator. Past just gives you a perspective. Okay, this is how things have worked in the past. Most likely, things should also work maybe in a similar fashion in the future. I'm not sure about the kind of returns which you will make, but data shows that equity has an amazing potential to beat inflation over a longer period of time. Now, what will be the returns, whether it be 12%, 13%, 14%, 15%? Honestly, nobody knows. But we are sure, I won't say 100% sure, but yes, data shows that predominantly over a longer period of time, equity has an amazing potential to beat inflation over a period of time. And that's why we call it investments. That's why we call it wealth creation. Now, let's try to understand the big money mistakes which happens in the entire journey. The idea is, unfortunately, people just jump into investing without even deciding their financial goals. First of all, when anybody is investing into equity mutual funds, one has to understand that we are basically talking about long term goals. We're not talking about short term goals which you have to achieve in 1 year, 2 year, 3 year. And I don't think equity is an asset class for achieving your short term goals, which is from 1, 2, or 3 years. Equity mutual funds, SIPs, are an amazing asset class which can help you achieve your long term goals. And which are the big three long term goals which most of us are planning for? First is our children's higher education. We all know the cost of education, the cost of inflation is very high. Whether we like it or dislike it, the cost of education is only going to escalate over a period of time. Second, many Indians, many of us would love to also sponsor our children's wedding because wedding is a big affair in India and we all know the cost is high. And yes, we want to save and invest for our children's wedding also. But the most important goal, which I say the most important long term goal, because for your children's education, the child will get an education loan. Even for his marriage, he or she will get they will get a loan for that. But there is a very important and a critical role which we all of us have to understand, which is called as retirement. I don't know it's a good thing or a bad thing. Many of us will live very long, and many of us also work in service industry. And if you look at service industry in general, many of us will have to retire at the age of 50, 55, max 60. I don't think any company will keep us beyond 60. So imagine that if you're retiring at the age of 50 or 55 and we continue to live till the age of 85, there'll be a 30 years of zero income life, 30 years of retirement. And that's the reason it's like a ticking time bomb in our country. Many people, okay, the straight away they want to know about which investment, they're not able to understand for which goals we are talking about. And it's very difficult for a human brain, no matter how intelligent you are, to think beyond 5 years. And that's why people don't think about retirement when they're in their 30s or 40s. They realize about retirement at the age of 50 and 55. That's quite late. Idea is one should be aware at the age of 30, 35, 40, 45. Even if it's 50, no worries. You have got still 10 years. You can still save a lot of money, invest a lot of money to achieve good amount of corpus for your long term. Now, first thing is the big money mistake which I've seen people doing is not defining their goal, not writing down their goals. Write down your goals, be specific about long term, medium term, short term, and equity as an investment is for long term. It's not for your short term goal. Second point, the problem is yes, we think reading newspapers makes us very knowledgeable. Good. It's good to read newspapers. It's good to follow politics, elections, budgets, what's happening across the world, what's happening in Asia, what's happening with our neighbors, Pakistan, Bangladesh, China, European problems, and all that stuff. But the problem is, even India is an amazing country. India has a population of 140 crores. Okay, just to give you things in perspective, entire Europe is 70 crores, entire America is 30 crores, entire South America is 40 crores. You just merge all these places together, that's India's population. So the idea is, yes, we have so many people. The idea is when you look at news, you'll always look at bad news. Unfortunately, there is nothing called as good news because news by definition, technically, there are three kinds of news: either a unique news, or a negative news, or an imaginary negative news. Good news, something which is good happening in the country, will never make headlines or rarely make headlines. But let me tell you something very interesting or fascinating about the kind of growth India is experiencing and why we need to actually invest in a logical fashion to take the benefit of this long-term growth. In the year 2000, India's GDP was approximately $500 billion. As we speak right now, India's GDP is around $3,500 billion. If you do a simple maths, you will realize that in just matter of 24 years, our GDP has multiplied or moved 7 times. That means in the year 2000, there was one India. In just matter of 24 years, 6 more Indias got produced. That's the kind of phenomenal growth this country is going through. And it's not just last 20, 25 years. If you look at the history from 1980 till now, if you look at the chart, the annual GDP growth, barring 2020, where we had a COVID kind of problem, where we had a recession, which is negative real GDP, practically every year, India's GDP goes up. This clearly shows that India is an amazing large growth economy. And if the country is growing, it is very important for us to participate in this India's growth story, invest into stocks, invest into equity mutual funds to create wealth over a longer period of time. The problem is good news hardly gets noticed. It's only bad news, okay, which makes headlines and we feel very anxious about it. Now, I understand, okay, we are feeling very anxious about the markets right now. And I'll tell you why it's happening. It's happening because of a very big behavior mistake which we all of us go through, which is called as recency. The problem is a human brain only recollects what happens very recent. So if you ask me, okay, cricket is going on. If India played amazing in the previous match, you will say, wow, India is amazing. But if in case the previous match, India for some reason played badly, and our logic is very simple. It's a pathetic team. It doesn't know how to play and stuff like that. Recent things play a very big role. What has happened? From year 2020, markets were doing well. 2020, they did well. 21, they did well. 22, they did well. 23, they did well. 24 also, they did reasonably very well. It's just that in the last 6-7 months, markets are not doing well. The problem is it's a human nature to give too much importance, excess importance to recent information. Like for example, today gold is doing well. A lot of people want to invest into gold. Again, an example of recency. Anything which is doing well in recency, people just want to rush over there. The idea is this is not how you create wealth. We get blinded by recent returns. As smart investors, what we have to look is the long-term journey of any asset class. Because in the long-term journey, when I just spoke to you and I gave you an example of HDFC FlexiCap Fund, it was not a straight line in the last 30 years. In fact, if I give you a perspective, what happened in this 30 years, there were good times, there were bad times, there were amazing times, there were horrible times, there were crazy times. In fact, when we launched the fund in the year 1995, for the first 2 years, the fund actually gave negative returns. It was not doing well. Imagine if you are a SIP investor, most likely you would have stopped your SIP. But 97, 98, 99, these 3 years, markets did very well. And then in 2000, because of dot-com bubble, IT bubble, tech bubble, globally equity market corrected. Even our equity markets were correcting because of global problems and even domestic problems. So 2000, 2001, 2002, 2.5 years, there was a big fall in equity markets. Even this fund corrected disproportionately. Then there was a big, amazing rally in equity market, 2003, 2004, 2005, 2006, 2007. For 4-5 years, this fund was doing exceedingly well. And then we all know 2008 happened. There was a global financial crisis. Markets globally corrected. Even emerging markets corrected. Even Indian equity markets corrected along with that. This fund also corrected along with that. Then again, 2009, we saw a strong pullback in equity market returns, where the world was talking about recession. Everybody wanted to stay away from equity market. Everybody said, we have burnt our fingers. We'll never come back to equity market. 2009, this fund bounced back and equity market bounced back and it delivered amazing returns. 2010, 11, 12, 13, 14, for 4-5 years, the fund was doing reasonably well. Not much, not bad, nothing great, nothing bad also at the same time. The markets were almost going through their boring phase, neither a bull market, neither a bear market. 2014, 15, 16, 17, 18, 19, 20, 6 years. There were some ups and downs, but the fund was slowly and gradually going on the upward direction. Till March 2020 happened, COVID, pandemic, everybody in the world frightened, including Indian equity markets. We saw free fall in equity markets. market corrected by almost 30% in just matter of 1 month. And then again, the market started bouncing back. Things became better. Funds were doing well for the next last 3-4 years. The fund was doing exceedingly well. And then again, there has been some drop in the returns because last 5-6 months markets are not doing that well. What do we learn from the entire journey? The only thing what we understand from the entire journey is that when we say, just as an example, not that this fund has given 12%, when we say that equity market can potentially give inflation beating returns, let's say 10% or 11% or 12% or maybe slightly higher over a period of time, it doesn't mean that the fund will give the returns of 12, 13 or whatever, the same returns every year. The fund will have good periods, they'll have bad periods, but over a longer period of time, the fund delivers amazing returns. It's exceedingly important for us to understand history of markets. It is very important to always remind ourselves that the world was uncertain, is uncertain, and will always be uncertain. Market was volatile, is volatile, and will always be volatile. Volatility is the nature of equity market. Unfortunately, we give too much importance to recent events. So whenever recent events, whether it's good or bad, we should look at the long-term journey of HDFC FlexiCap and remind ourselves that in the long term, this is how you create wealth. Now, we all know about seasons, okay? We all know that there can never be snow 24/7 for 365 days. We also know there cannot be summers and there cannot be one season, okay, which is there for the entire year. Same way, markets also has seasons. They have cycles. There is ups, there are downs. Market moves like pendulum. There is sometimes there is optimism, sometimes there is pessimism. In the short term, market moves based on emotions, psychology, and emotions. But in the long term, what drives equity markets are profits and earnings. So in the long term, market follows earnings, but in the short term, market is basically oscillating because of emotions. Now, I also seen very big mistakes a lot of people are doing. The problem is that many times smart people think, okay, I'm smart, I'm intelligent, I'll buy my own stock, I'll do my research, I understand the entire world, and I'll take concentrated bets. I'll just buy few stocks and I'll put a lot of money over there. But one thing we all of us have to understand that business by nature is very risky. Not all businesses do well. I'm sure without talking about any stocks, I'm sure many of you have been there in the market observing many companies over a period of time. You will realize that any sector, so there are many sectors, this is Nifty 500 for you, the index. India is blessed to have possibly all possible sectors which are there, and no one sector dominating the entire stock market. We have got financials, we have got oil and gas, we have got IT, information technology, automobiles, auto ancillaries, FMCG, capital goods, healthcare, power, metals, mining, everything. We've got most of the sectors out over here. And within every sector, we have got so many companies. But look at history. You will realize that not all companies do well. In fact, data shows only few companies do exceedingly well. Many are also average companies, and many companies also fail. Okay, and that's how the nature of business is. And that's why we remind all our investors that the only way of creating amazing sustainable wealth is through diversification. And what do we mean by diversification? Don't put your money into one stock or one sector, but diversify your money across various stocks and various sectors, which actually mutual funds do it for you. If you look at a flexi cap fund or a multi cap, large and mid cap, dividend yield, or any diversified fund, they don't put all the money into one stock or one sector, they diversify it. And that is exceedingly important to create wealth over a longer period of time. It manages risk in a more logical fashion, which unfortunately many investors, in fact, smart people make sometimes these mistakes because they think, oh, let me put all my money into few stocks. But who says, who guarantees you that these stocks will do well? Diversification is the best way of managing risk. Now, also, I've seen people chasing sectors, and this is a very simple chart which makes all of us humble. The idea is very simple. It's very difficult to time which sector will do well. Okay, if you look at any trends, let's say pharma or FMCG or metals or banking or IT, you will realize that there is a big movement happening. Sometimes banking does well, and suddenly in the next year it comes last. So a simple logical way is to diversify your portfolio and which sectors to be overweight or underweight. Let the fund manager decide that. The fund manager's job, the reason why you pay a fees and you give the money to a fund manager is only because his job is to figure out which sectors will do well, which stocks in the sectors will do well, and that's how they build the portfolio. The idea is allow fund managers to do their job. Don't try to be a fund manager. Another big mistake which I've seen generally people doing, we also have to remember that anything what we do in life is a combination of luck and skill. Like, for example, India is doing phenomenally well when it comes to chess. Chess is mainly skill based. Yes, luck also plays some role over there, but it's broadly skill based. And we also know so many uh, games, especially like lottery, roulette, they are purely luck based. Okay, skill has very less role to play over here. And then there are many games which come in between, and they all have a combination of luck and skill. The interesting point is investment also has a very good component of luck and a very good component of skill. And that's the reason many times what happens that when people, for some reason, they have good returns, okay, they just buy random stocks and the stocks are doing well because of luck. Maybe they have not researched the balance sheet. They just bought those stocks based on tips. Somebody told something on media, some friend, some relative, some WhatsApp message. The person buys couple of stocks, he makes money, and he starts believing that he's very smart, very intelligent because there is outcome to prove that. But the idea is that's not called as investing. Maybe you made some money, or maybe you made good money, but that's maybe because of luck. Good money, good sustainable money is made only through processes where you do good research, read your balance sheets, understand promoters, do forensic accounting, diversify your portfolio. And that's why mutual funds, according to me, are one of the finest products to create wealth over a period of time. What should be our idea? And this is a very good framework for you to take decisions. A good process and a good outcome deserves success. Absolutely. But a good process with a bad outcome, okay, is bad break. That's fine. It happens. But a bad process of randomly buying stocks, but you are lucky, that's called dumb luck just because the outcome is good. Okay, bad process and bad outcome obviously gets filtered out. The idea is stick with good processes, and I'm sure with good processes. And what are good processes? Mutual funds, diversification of mutual funds, asset allocation. Till now I've been talking only about equity mutual funds and wealth creation, but it's not only equity mutual funds. Mutual funds also have got fixed income. Fixed income is a very amazing asset class which gives you stability in the entire portfolio. Mutual funds can also give you access to gold, to silver. Commodities are also there. So basically, as a good investor, you should have some money into equity mutual funds. You should have some money into FDs and fixed income. You should have some money in real estate, a house where you have to stay, and some money in commodities. When I say commodity means basically gold and some amount of silver. Yes, physical gold is good, jewelry is good, physical coins are good, but understand gold mutual funds, SIPs in gold mutual funds, lump sum in gold mutual funds, SIP in silver, SIP in lump sum in silver mutual funds are also very good ideas. They don't have any making charges, they don't have any impurity. You can track them very well, very liquid. You can also try commodity driven funds, which is gold mutual funds and silver mutual funds, to create wealth over a longer period of time. Now, one big mistake, unfortunately, most of us also do is herd mentality. Human beings are designed to live in herds. We feel very comfortable to see what others are doing and we take our decisions. I'm sure majority of a decision, when I look at my life, and I'm sure the same applies to you, is based on what others are doing. It might be good, okay, in many aspects of life, but especially when it comes to money, personal finance, and investing, it's a very bad idea. I've seen when markets are doing well, everybody wants to invest. And why do they want to invest? Because everybody is investing. And when markets start correcting, everybody wants to redeem. Why? Because everyone is redeeming. Don't follow others. Don't follow anyone. In fact, build your own unique plan when it comes to asset allocation and financial planning. Don't copy anyone, neither your neighbor, your friend, your relative, your cousin, the society in general. Don't follow anyone. Just make a very unique, customized plan based on your goals, your personality, your behavior, the way you look at money, your risk taking ability, and your psychology. Unfortunately, many times we make big blunders just by following others, and that's a big trap. Just it's a lonely journey. Listen to your advisor, because at the end of the day, everybody needs a friend who can understand us, our goals. Listen to your advisor, listen to your distributor, listen to your partner, and listen to the advice in terms of how they're helping you create wealth over a longer period of time. We also live in this world. In fact, today as we speak, there are more than 500 news channels. Try to remember 20 years back, there was only one Doordarshan, one channel, 20 minutes news, and that was our gateway to the entire world. But today, all news channels give you 24/7 news. Today, if you have a mobile phone, a YouTube, basically, even you can be a journalist. So we live in this world of 24/7 news, 24/7 information. And at the same time, there are thousands of options. There is no one mutual funds. There are 40, 50 mutual fund AMCs, asset management companies, each of them launching so many funds. And you get so confused and anxious what to do. The idea is, in this world where there is infinite information, you need to have processes. And what do you mean by processes? Stick to your plan, stick to your risk taking ability, decide which SIPs, which AMCs, which funds. The idea is, don't try to chase the best fund. Don't try to even find out the best fund. Try to be a best investor. Look at the long term track records of fund. Try to understand the fund manager, the portfolios, and take sensible logical choices rather than chasing returns, because that never creates returns over a longer period of time. Lastly, there are a couple of things. Okay, no matter how much we study, no matter how much news articles we read, no matter how much TV we watch, we will never have a complete fair idea of the entire world. We are basically like a very interesting Indian story. Okay, elephant and seven blind men. Okay, if somebody is touching the rope, the tail, he would say elephant is a rope. If someone is touching the body of the elephant, he will say it's a wall. So everybody has very limited worldview. Okay, somebody says India is a growth story. Somebody says no, you don't know the real India. A lot of poverty over here. A lot of it is right. Okay, everybody has got some aspect of India and the world. And unfortunately, what we experience is our only negative news. Okay, like this person, this gentleman reading a newspaper, there's a plane crash which happens, and he'll get scared by aeroplanes when actually flying, sitting in an aeroplane is one of the safest things. The idea is, unfortunately, we are designed to get anxious 24/7, and that's the reason we make blunders when it comes to investments in general. One more big problem for most of us is that we love complex ideas. Anything which is complex, we get attracted towards that. But actually, what creates wealth are simple ideas. What are simple ideas? Financial planning, writing down your goals, talking to your distributor, advisor, writing down your financial goals, doing asset allocation, equity mutual funds, fixed income mutual funds, FD, gold, real estate, SIPs, being disciplined, simple ideas. But unfortunately, people love complex ideas, and that's the reason, unfortunately, many investors don't create wealth from a long term perspective. There's also a big problem. Today, we live in the world with 24/7 entertainment and 24/7, okay, technology, where you can buy and sell with a click of a button. The problem is, people look at investments as entertainment, but entertainment hardly creates returns. Whenever you invest, whenever you plan, think about your family, think about your goals. Investment by nature has to be very boring. But I have seen generally men doing this and making a mistake, that they always love to boast about some stocks, some ideas where they made returns. It is not about, your job is just to invest. Your job is to just do financial planning and let markets do remaining stuff. It is not about entertainment. It's not getting up in the morning and checking your portfolio. In fact, people who check their portfolio on a daily basis, behavior finance says that you end up losing money, or you end up creating less amount of money over a longer period of time. You have to just invest and do nothing. Last but not the least, we live in the world, everybody is looking for shortcuts. Everybody is telling about how do you become a millionaire or a crorepati overnight. I don't know whether you become a crorepati, but you can obviously you can always lose your money in 1 second. Warren Buffett, one of the legendary investors, okay, he started at the age of 11. He started investing at the age of 11. Today, he's one of the richest investors. He's 92 years old. The idea is, that almost almost 99% of his wealth came after the age of 50. Let me repeat this sentence. Almost 99% of his wealth came after the age of 50. This clearly shows that when you're doing your SIPs, initially you might feel, oh God, I've done an SIP, it's been 5 years, 6 years, money is not growing because money compounding happens over a period of time. Initially things will not compound. I'll give you a simple example. Let's double your money. 1 becomes 2, 2 becomes 4, 8, 16, 32, 64, 128. Initially you might feel nothing is happening, but then there will come a point that a doubling from that level, 500 becomes 1000, 1000 becomes 2000. The idea is there will come a point where doubling actually creates amazing amount of wealth. And this is what happens with compounding. Initially you might feel nothing is happening, and that's fine. But over a period of time, 10 years, 15 years, 20 years, or maybe 30 years, if in case you can stay invested, you will create magic. You will create magic. Warren Buffett stayed invested for almost 70, 80 years. And that's the reason he's one of the richest investors in the entire world. The idea is to create wealth. The only thing what we require is time, patience, and discipline. I'll just end up with a few big thoughts. I understand, and these are CT scans of human brain, that when you have a profit, a certain part of the brain gets highlighted. When we have a loss, there is a certain part of the brain which gets highlighted. When market falls, it hurts all of us. That's human. We are human beings. It's impossible that we'll not feel the pain of loss. But the point is, we have to understand, and that's why emotional intelligence is very important. And that's why asset allocation is important. Like last 7, 8 months, I understand equity is not doing well, but gold is doing well. And if in case you had equity and gold and fixed income and real estate, equity might be down, but gold is doing well. Overall, your portfolio is doing very well. That's what we say about asset allocation. Have a very good asset allocation. The reason why people are awake at night and worried about money is only because they have done wrong asset allocation. Maybe they have invested less in equity and they are worried about wealth creation, or maybe they are overly invested in equity and they are worried about the risk which they have taken, or maybe they don't know what they are holding. They just bought random stocks instead of buying mutual funds, and that's the reason they're worried about markets. Okay, one has to be a very sensible and a logical investor. Talk to your advisor, talk to your mutual fund distributor, talk to your partner. Try to make a good financial plan so that you are able to achieve your financial goals. Lastly, this is how money is created. You can't, you know what the problem is, we look at our portfolios on a daily basis, it will not create wealth. We're talking about decades. People want to create wealth on days. This is what patience looks like. You don't have to just keep on looking at the grass. Let the grass grow, it will grow. Just allow your money to grow. What we require is faith. Borrow this faith or talk to your spouse, your wife, in terms of, okay. And that's why I sometimes feel women are far better investors. When they buy a jewelry, they keep it for decades, 10 years, 20 years, 30 years. Okay, you have to borrow that same amount of faith. You have to learn the same amount of faith in your financial planning. You have to respect time. Wealth creation happens with time, not with intelligence. You have to be disciplined. You should feel anxious if your SIP gets missed. You should be very ruthless. Every SIP should go every month, no matter what. As your income increases, increase your SIP amount. And last but not the least, manage your brain, manage your emotions, manage your greed, manage your fear, manage your the boredom which happens in the entire journey. Wealth is not created by intelligence, it's created by emotional intelligence. Lastly, I'll again talk about emotional intelligence and then we'll open the floor for questions. You have to you have to do mind gym. And what do you mean by mind gym? The mistakes, the blunders don't happen because of the markets. Markets were always like that. Markets were volatile, are volatile, and will always be volatile. The world was uncertain, is uncertain, and will always be uncertain. India as a story, India as a growth story is doing phenomenally well. India as a young country, has got immense potential. We are experiencing that growth on a daily basis. When markets go up, still manage your emotions. When market go down, still manage your emotions. Stick to your plan. Stick to discipline. Stick to the idea of asset allocation at all given points of time. Uh, Talk to your advisor. Don't try to find the best fund. Ask an advisor and your distributor, how do I become a good investor? How do I become the best investor rather than asking about the best fund? Okay, talk about your goals, talk about your anxiety, talk about your uncertainty, talk about your behavior mistakes, and that's how we'll be able to create amazing amount of wealth over a longer period of time. Now, plan of action, just rewinding what we have already discussed. You need to have four things in your portfolio: growth assets, equity, mutual funds. And there are many mutual funds: flexi cap, multi cap, large and mid cap. You can also invest into hybrid funds, balance advantage fund, aggressive hybrid fund, multi-asset fund, equity, debt, and gold. You can invest into that. If you are scared, don't want to put all your money at one go, lump sum, you can also do STPs, staggering your investments over a period of time. If you're scared to put all your money in one asset class at one point of time. So you need to have growth assets in your portfolio. You also need to have safe assets, relatively safe assets, fixed income mutual funds, FDs also in your portfolio. To manage uncertainty, have gold in your portfolio, gold mutual funds, silver mutual funds also in your portfolio. Have liquid funds for uncertainty. Keep some cash also in your portfolio. And we're also recommending that, yes, it's good to have a house, okay, to stay, okay, but don't over invest in real estate. It's a very illiquid assets. You cannot also sell your balcony or kitchen when you require money, okay, and very difficult to manage and operate. Maybe a house to stay, that's sufficient. Ideally, diversify your money across these four asset classes. Stay disciplined, stay focused, and I'm sure you'll be able to create amazing amount of wealth over a longer period of time. With this, we will end the session, and I hope you enjoyed it. I hope you understood the big money mistakes which all of us do. Uh, and don't think that just because I'm talking about these mistakes, I have not done these mistakes. Even I have done many of these mistakes. I am trying to be a better investor, because at the end of the day, we all are human beings. We make mistakes, but we have to learn from our mistakes and become a better investor. With this, we'll end the session. And if in case we have any questions, we are happy to answer. Thank you.
Wonderful presentation, sir. From basic to advanced, everything is clear. But still, there are 2-3 questions in between.
If you have any
Also,
questions, you
their
can put your
answers.
question in the chat box, and we'll try to answer your questions.
Okay. Uh, uh, there are few questions are in between the presentation, but the answer is already given. But for the benefit of the clients, I just repeat the questions. Due to this market condition, I should stop my SIP or not? So this is one of the customer is asking this question.
Right. See, understand that SIP is investment on a monthly basis. Okay. And we are talking about, first go and re-examine, why did you start the SIP at first place? Was this SIP for 1 year, 2 year, or 3 year? SIPs, we do it for a long term goal. Like I'm doing my SIPs for my retirement, for my children's education, for their marriage. They are long term, 15, 20, 25 years goal. What is happening in the market? Okay. Maybe large caps have corrected 10-12%, mid caps have maybe, let's say, corrected 20-25%. Okay. Look at history. Is it happening for the first time? And ask yourself, is this the last time it will happen? I just showed you the history of HDFC Flexi Cap. How many times this fund has corrected in 30 years? This fund would have corrected maybe 30 times. And sometimes this fund would have even corrected 30-40%. In fact, market corrections are the best period, the best periods for SIPs, because your buying is happening at lower valuations. Your buying is happening at lower levels. If you're not able to participate now when markets are falling, that means your SIP is enjoying. It is buying the units at a lower price. It's getting more units. And that's how you create wealth over a period of time. As an investor, as an SIP investor, yes, it's good to celebrate bull markets when market is going up because your value is going up. But it's more, you should celebrate more bear markets because you are getting more units. Our job is to accumulate more units, okay, and not get carried away. Market upar gaya, niche gaya. I'll just tell you one more thing. I have seen from my mistakes in 2008. Okay, so a lot of people started the SIP in 2006, 7, 8. Okay, in 2008 when markets corrected, I saw many investors stopping their SIPs, and in 2009 they regretted because markets moved up and they said, "Oh God, we made a mistake, we made a blunder. We should have not stopped our SIPs. The values are good now." The same mistake happened in COVID time, 2015, 16, 17, 18, 19, 20. People were doing their SIPs. Suddenly markets went down. SIP returns went negative. People stopped their SIPs because people couldn't see negative returns. And then when markets bounced back, again they made the same mistake. we should have not stopped our SIP. The idea is learn from mistakes what people have done in the past, okay? Because same mistakes get repeated again and again. Don't even think about stopping your SIP no matter whatever happens. Even if market falls 10%, do more SIPs, even 20%, nothing is going to happen. In the long term, you will create amazing wealth. Stay disciplined, stay patient, and enjoy the entire journey.
Okay. One question is that in this market scenario, SIP is the good option, or a lump sum money should be a good option?
See, SIP is no matter whichever the market, okay, if you have asked me this question 10 years, 5 years, today, and even 5 years, 10 years, 20 years down the line, I'll say SIP is always a good option, period. So SIP is always good. Lump sum, it all depends. I'm not here to say that lump sum is good now or bad. It all depends upon your risk appetite. If your time horizon is above 7 years, 10 years, then equity mutual funds is an amazing option. If you would have asked me the same question 5 years back, should I put lump sum? Again, my answer would have been, if your time horizon is more than 7, 10 years, lump sum is a good option. I'll again say, if in case you're slightly worried that God forbid if market falls more and you don't want to commit all your money right now, maybe you can do STP, where your money gets staggered over a period of time. But if you're confident and if you're long-term investors, just put this money into equity mutual funds, a good diversified fund. And if in case you don't want to put all your money into equity, maybe you can also use hybrid funds, okay, aggressive hybrid fund or a multi-asset fund. But if in case, I'll again say, if your horizon is 7, 10 years plus, or 15 years, 20 years plus, I think use this opportunity to add more money from a long-term perspective.
Okay. So moral of the story is that write down your goals. According to your goals, just sit with your advisor or a partner, then plan how much SIP you should increase or how much lump sum you should do, and in which category of fund, either balance advantage or a equity hybrid or a purely equity fund, you should invest. Your advisor will guide you more precisely and betterly. Okay. Appreciation. There are so much appreciation from the client side, sir. Amit sir, thank you so much for this wonderful session. Thank you so much, all the investors, to participate in this wonderful session. All the best for your achieving your financial goals. Thank you so much, Amit ji. Thank you.
Thank you, sir. And have a good week. And I'm just saying that stay patient, stay disciplined, enjoy the drama. In Hindi कहते हैं ये वक्त भी गुजर जाएगा, and this is all part of investment journey. So I think we should not get too emotional about what's happening.
Lastly, moral of the entire session is market where volatile, market is volatile, market will be in a volatile. So you should be a calm person
Absolutely.
to be a successful investor.
Absolutely.
Thank you so much. Thank you, sir.
Thank you. Happy investing.
Thank you all the investors. Thank you.